Okay. So now more than ever, I see and hear so much confusion out there. The other thing, I'm going to go ahead and turn off my camera so you can just focus on the content, and you'll hear me talk over it. And we'll come back at the end, and for some, we have Q&A at the end. So I'm excited for and appreciate you guys taking your time to be here today. The goal here, main goal, is to help minimize the confusion and help people have more clarity, help them understand what's the wrong way for them, find the right way for them. I think that financial world is always complex and clear. There's a lot of conflicted messages. We'll talk a little bit about some of the reasons why that is. And I think it's important that you consider that. I think it's so important that you consider the messenger, right? What is their agenda? Everyone has some sort of agenda. And ideally, you're not like this, looking like this, or looking or feeling like this woman here, in the bottom left. And in my experience, I've been working, over 10 years with a lot of retirees and people approaching retirement, and there's just way too many people that look and feel like this. And so one of my goals is to help change that and have more people have confidence and clarity with their decisions and their path. And I think I found the best way to do that is to take a comprehensive approach and to look at the whole picture. That's not always the case. And I think when that's not the case, oftentimes it even creates even more confusion, right? Is this right for me, or is this being recommended because those are the tools and that's what that individual or that company does? So really looking at the big picture, and now more than ever, especially if the less margin of error you have, I think the more important it is to get multiple benefit areas covered with your choices. And we'll talk a little bit more about that as we go through, because there are tools. Traditional investments just focus on growth and growing of your money, which is, of course, is important. But oftentimes there's other factors that come to mind, especially as people approach retirement or in retirement, such as protecting and not taking big losses, such as being tax efficient, maximizing assets for beneficiaries, protecting from care, all these other pieces of the puzzle. So a little bit more about our approach, what we believe, how we try to tackle all these issues and strive to help people create the best outcomes for them and their family. As I did mention, I think it's so important that you be careful, who you listen to. So I will take a couple of minutes and tell you a little bit more about why you might want to tune in and listen to me. But really, I just try to demonstrate that knowledge by, what we're doing today, spending an hour or so together, sharing good ideas. We do these throughout the Las Vegas area when possible, right? Not so much in 2020. So, the webinars is our way of adapting and being able to still reach and connect and help people. Probably, for many people now more than ever, they're reassessing things and really trying to figure out what's the right approach and what do they need to be doing. And so this is in addition to being investment and insurance licensed and being independent, I also have this advanced designation from the American College, Wealth Management Certified Professional. I also have, this is another one I have, Retirement Income Certified Professional. So this is all about getting down the mountain, right? So many people in the industry just focus on growing of the money, and we do too, right? That's wealth management. That's important, especially so to get people to retirement during their working years when they have salary and income to rely on, and they're making contributions. Losses along the way aren't typically as devastating in those situations. But I also have a third designation, Life and Annuity Certified Professional, and I think that really differentiates me as far as the really understanding of those product types and understanding when those tools are great solutions, and just as importantly, when those are not the right tools. and we'll talk a lot about different financial tools. I've lived in the Las Vegas area for almost 20 years now. I love Las Vegas, like a lot of you. A lot of people all over the world, right, move here, come here, right, for a lot of different reasons. And we have a lot of clients and friends at the retirement communities here. And I'm also becoming more of a virtual advisor. We do have clients in multiple states, and through technology, we're able to reach more people and help more people when it's a fit, when they like our approach and philosophy and they like my experience and knowledge and they want to apply it to their situation to create the best outcome for themselves. So I want to take just a couple of minutes. We're going to talk. I already shared quite a bit about what. We're going to talk quite a bit about the how when we go through our process. So I want to just take a couple of minutes and share a little bit about why I do what I do. This is a picture of me and my grandfather almost 40 years ago, 35 plus. I think I was 7 years old here, a lot more hair, right? We have a little Kodak camera. So my grandfather was a big influence on me. He was a successful businessman, entrepreneur, but he didn't adapt. He was in the technology business, and technology changed, and he didn't. And he had a lot of financial pain in his retirement years. And so he had a lot of bitterness. And I think that's one of the things I like about working with retirees is trying to provide them peace of mind and confidence in what they're doing, so that help as many people avoid those types of situations. Also myself, in addition, I wish I would have learned more from witnessing him when I was, 10, 12, 13. He passed away when I was 16. But so when I jumped into investing and the world, I had a lot of success, and I just expected that to always continue. And heavily invested in real estate in the early mid 2000s. And there's nothing wrong with any one asset class. There's nothing wrong with real estate, but the way I approached it was overly aggressive. And we all know what happened after that. And so that's an important lesson, is that when things are going good, a lot of times it doesn't matter. But when things aren't in your favor, when you have negative cycles, a lot of times, if you don't do good planning, if you don't diversify properly, it can cause a lot of financial pain, a lot of financial stress, which it did for me and my family for many years. Now, fortunately, I had a lot of belief in myself and a lot of commitment, and I learned and I adapted, and I made some changes. And what I learned makes me a much better advisor to help other individuals with their choices, and to hopefully not only to help for many people that already have financial independence maintain it, but help with many other people achieve it and then also maintain it. A lot of people achieve it, they don't maintain it because they never take their foot off the pedal. They're always playing too much offense. They don't have the defense, and they don't focus on things they can control, such as tax planning, understanding, making great decisions there, taking advantage of their annual opportunities. So it's also, I love what I do. It's so much fun to be able to strategize and help people make good decisions, and to hopefully help them and their families have their best life, right? So when you have financial freedom, financial independence, you're able to do more of what you like, do less of what you don't like. That's how I like to live my life. And so it's really the best use of my talents and contribution and service to others. So that's really about what gets me excited and motivated to get up and do what I do each day. We talked a little bit about the what, and I always like to talk. It's always fun and exciting to talk about the what and the different options and all that. And so today we're really going to spend a lot of time on that how there. So, and what I found over the years is, there's a lot of different planning approaches. It's not necessarily that there's one that's right or wrong. What I found, and many of my clients have found as well, is that this process, which we call the bucket plan, is the best approach from a combination of simplicity and comprehensiveness, right? There's plenty of things that are simple, but then there's unaddressed gaps and unaddressed problems. So you'll see this image several times if it's not familiar with you or familiar to you, but I want to just drive briefly on the simplicity of it. So we focus primarily in three core concepts. So what is your timeline around the money, right? You have these three buckets: the now, the soon, and the later, right? Generally, the now is the next year. The soon is years 2 through 10, maybe a little bit shorter if you're older. And then the later bucket is year 10 plus, or if we do years 2 through 5 in the soon, 6 plus in the later. But so that's the timeline. When are you going to need this money is so important, and what's the best choice for this money? What's the purpose? Is it a growth strategy? Is it an income strategy? Is it a protection strategy? Is it a legacy strategy? Is it a combination of those things? And then, so important, what is your personal risk tolerance? Because if people get in above their head and they take more risk than they're comfortable with, which is often the case, that generally, it works fine when everything's working fine, but when you have negative cycles like December 2018, March 2020, it causes a lot of stress, it causes a lot of worry, it can cause them to make decisions they shouldn't make, cause them to, in some cases, lose their financial independence. And so if we know those things are coming, and I think anyone that's invested for more than 10 plus years should understand that those types of things regularly occur. So it shouldn't be a surprise when they occur. We just don't, it's just hard to predict exactly how the frequency of them, when exactly, how long it's going to take to recover, and all those other things. So if you like this bucket plan concept, there is a book that's very narrative about it. It's a great read. Obviously, I'm also a certified advisor in this planning process. We have a customized version. So for people that meet with me, or I generally give, if I think it could add value for them, I generally give a copy of the book. If you're watching this on the recording, you can also just go get it on Amazon, the non-customized version. Also for our clients, if you have a friend or family member that you think could benefit from this, we're always happy to provide a copy of the book for you to share with them. So the bucket plan process, this 6-step process. And when we talk about the money cycle, it's the accumulation years, right? The protection years, and the distribution years. The protection years are generally the years 5 years before retirement, 5 years into retirement. And there's often a lot of similarity between the protection years and the distribution years, but they are so different, those two time frames, than the accumulation years. So it's important to understand that. I just briefly highlighted the philosophy, and then obviously you can't create a plan for someone unless you know the details of their situation, what sort of income gap they may have in retirement if they're not already retired, their personal volatility, comfort with risk and uncertainty, and then we can create their bucket plan. So what you're going to, you're going to experience 3 example bucket plans, but before we get into that, when you're working with an independent advisor, they don't care what the tools that we're going to use are, right? When you're working with more of a broker or a salesperson that have limited tools, they may only have 2 or 3 or 4 tools that they're licensed for, that they're familiar with, that they recommend. I think it's much more likely to have negative outcomes because it creates an increased likelihood that it's not the right tool for you. It's just, that's what they sell. That's what they use. So there's a lot of different tools here. There's 14 of them here. There's a few that aren't on here as well that could work. But the main thing to understand, and we're going to talk a little bit about, stocks and bonds are typically the most popular, especially during the accumulation years. And again, the challenge becomes for a lot of people is when they're approaching the protection years, approaching retirement, in retirement, the distribution years, is how do we adjust? And to what degree do we adjust, and what do we adjust to, right? I call it de-risking, right? If we're going down the pyramid, right? We're having less money in things that are up here and more money in things that are down here. And often the challenge, there's a lot of confusion around that, right? Because there's a lot, if you're working with an investment only advisor, a lot of times they don't want to lose that business. So they're less likely to tell you, right? Hey, I think it's the right choice to reduce 20% of this and put it here, right? So if you're working with an advisor that works with multiple tools, they shouldn't care which tool is being utilized. They should care about making sure that you have the right tools for you. And so this is my process to help my clients do that. And so I can't give to people ask, what do you think I should do? And, do you think this is good? And it's like, well, maybe, I don't know, like until we have a lot more conversation. I mean, how can you really, give appropriate advice? So there's just too much general advice out there, and it's worse because of the internet and the information age, and you can find good and bad about any one of these different tools, right? So number one, it's understanding someone's financial picture, factoring in their liquidity needs. So liquidity is access to your money. So there are, for example, things like, so real estate could be a great investment tool, but if you need money quickly, it might be one of the worst ones, right? Goals, your investment objectives. Again, we talked to that'll make I'll share with you, one of the worksheets we use to help understand that. But again, is it a growth? Is it protection? Is taxes, and is income down the road? What's going on? What are we trying to achieve? Personal risk tolerance, and then risk capacity. And so, which I want to share with you a little bit more about the tolerance and capacity. I think that's often another area that people don't get right. And so if you go through, if maybe you've been through it before, as far as when you're opening an investment account, it's very typical to be asked some questions like this, right? When do you plan on needing the money? Are you taking money? Are you relying are you taking money out of your accounts now? And so these are a couple of questions that are on part of our risk profile questionnaire. And so the higher the score, it's going to suggest individuals to take more risk. And so again, if we're talking to a 45-year-old, right, or 50-year-old, right, in most cases, they're going to say, well, I have more than 10 years and I don't rely on it at all. So it's going to suggest that they invest maybe, we have 5 categories, aggressive, moderate, conservative, and then moderate, conservative, moderate, aggressive. But what I found over the years is that just because someone can afford to take large losses doesn't mean that they're equipped and that's the right choice for them, right? And also, just because somebody maybe they can tolerate it emotionally, but capacity-wise, they don't, right? If they're relying on income, maybe they can't sustain a 20-30% loss and continue to take that income and have a solid plan that they won't outlive that money. So this is the emotional aspect. And so if you answer these questions, right, and I think this is such a great opportunity, the times we're living in, to really reassess and make these right decisions for yourself now, because you've just lived through, this a couple times in recent years. So you may have, and if you're retired or approaching retirement, you lived through this in 2000, you lived through this in 2008, but that may have been different for you because you may have been in your accumulation years, right? You may not have been drawing on the income. And so if that's the case for you, like many others in that scenario, you would very likely feel differently today than you did then, right? Because you're relying on income now, or you will be relying on income in a year or 4 years rather than 10 plus, right? But if you know that this is what you'd want to do, move to cash or change the strategy to more conservative, then it becomes more important to not have money, especially not have too much money working that way, because you don't want to do that. Ideally, you want to be over here and let the ups and downs of the market work in your favor. But you need time, and you need to be able to stomach the uncertainty. And some people, even when they're young, can't do that, don't want to do that. So it's not a matter of it's a right way or it's a wrong way. It's just what is right for you based on understanding how you're going to react and what's comfortable for you. Generally, there's a trade-off, right? If you're not willing to accept the downs of equities, you generally don't get the upside, right, that equities can provide. But as we know, over a short-term time frame, we just don't know, right? So this is a very traditional approach. And what the main thing I want to point out here is, again, I showed you the pyramid of risk. I showed you 14 different asset classes. Well, here we have 3. And this is the old way of doing things. This is called modern portfolio theory, right? So depending on someone's risk tolerance, that's how you recommend or allocate the percentage in stocks and bonds. And also generally, the older they get, you know, you reduce the stocks, you increase the bonds, and that may have this. And so there's a few challenges here that a lot of people face. Number one, there's still a lot of companies and still a lot of advisors that do this as their primary planning approach, primary recommendations. And I think this approach is fraught with so much peril and so much uncertainty that unless you're a very aggressive retiree, this is just not right for you. As simple as that. And so the question is, well, what is? And so, and to what degree? And I'll show you some of the things how we approach that. Number two, another thing that really is a challenge for people is just because they were doing something and it worked out well in the past doesn't mean that that same activity, same strategy, same approach is going to work out well in the future. So as an advisor, as a strategist, I look ahead, right? I mean, I try to learn from the past, but think about it. If you're driving your car, you don't drive your car focused on the rear view mirror, right? Because you may hit something right in front of you, but if you didn't look in front of you, you're not going to see it, right? So there's so much obstacles right in front. But when you're driving, you do both, right? If you got a crazy person in the back coming, you want to see it, right? But you're focused more on the front. And so how does that relate to this? So if you look at 10-year treasury and interest rates, go back 20 years and you'll look, and the 10-year treasury rate has been declining steadily over that period of time. And it's at as low as it's ever been. Now, bonds benefit from declining interest rates, the value of bonds. So if you owned a bond 5 years ago, it's much more valuable than buying into it today because you have a much higher interest rate. So not only do you benefit from the interest on the coupon on the bond, or if you have a bond fund like most people do, the interest that is generated there, you've also benefited greatly from the increase in value as interest rates have declined. Now, so you have to ask yourself, fantastic, but what does that look like moving forward? And I would say not very pretty. I'm not going to spend too much more time on that today. There's plenty of recordings and where I talk much more in depth about that. But so what are the alternatives, right? So one of the tools that we utilize quite a bit, so I'm going to share with you the 2 primary ones as an alternative to the conservative portion of the portfolio for bonds and bond funds. So on this chart here, we have the red line, and we have several lines. So the red line is the S&P 500. This is equities. And we use equities in clients' portfolio. It's just we generally don't use them as much as everyone else, right? Because that's very common. So most people already have stocks and bonds. So, in some cases, that I add value for them in that way. But in a lot of cases, it's, of these other tools and to what degree, and then creating the plan and then monitoring and adjusting the whole comprehensive plan. So these other lines, so this blue line here is a fixed rate, 2.5% fixed rate over a 20-year period. And so this is like a CD, or in this example, a 2.5% fixed annuity. Now, so this is, if we think about the tortoise and the hare approach, you can do really well, you could get hurt really bad. That's the red line. And the blue, the slow and steady approach is not necessarily designed to do better than the aggressive approach, but it can, and over certain periods of time, right? Now, but most people that have money working in this slow and steady approach aren't doing it because they want to make sure they make 2.5%. They're doing it because they want to make sure they don't take large losses. And so over the years, about 25 years ago, insurance companies started to develop alternative products. And that's these light blue line and this green line here. It's called a fixed indexed, the index insurance strategy, not to be confused with an index investment fund, right? Because you can invest in a fund, mutual fund, and ETF that behaves, that moves like this S&P 500, but that's not what we're talking about here. This is an indexed insurance strategy. It's available on an index annuity or index universal life. And how that works is we don't know exactly how much interest you're going to earn every year. We just know that the worst case is zero. I'm going to repeat that. The worst case is zero. You cannot lose your principal based on market declines. Now, that's very powerful. Now, after you have protection, you want to maximize your upside. So there's plenty of index annuities that are not very attractive. There are plenty of index annuities that I would not recommend, but there's a handful that are very attractive and that we do recommend. And how these work is, again, when the indexes go down, the client gets a zero. When the index goes up, they participate in the gain up to a certain amount. This is two examples of the ways that they can do that. A participation rate where they get 40% of the up of the index in good years and then zero of the down, as well as a cap. So a cap limits your growth. So you will hear plenty of negative talk around these products. Oh, you don't want those because, they limit your growth. Well, you might not want that for all your money, but you may want some of your money. You may be okay with that for some of your money. You don't have to worry about going to zero, right? Other tools, so that's an index insurance approach, not an investment. Insurance products are not investments, because anything that's fixed is not an investment, because investments, you can lose your money. Investments, there's no guarantees. And so, but investments are generally great because they give you more upside, they provide more liquidity. And so we use structured notes quite a bit, again, as an alternative, depending on the client. So for our more conservative clients, this is going to be some of their later bucket strategies. For some of our more moderate or moderate aggressive clients, this is more of a soon strategy, and that will make sense as we get into the examples, which we're almost there. I just wanted to build this foundation so that when I share that with you, you're not like, what is he talking about? And I've never heard of that structure note thing, because if you're like 99% of other people, that would be, you'd be normal before you met me or listened to me. Or these are institutional style investments that we can provide our retail clients. That most people, aren't able to get through other, I don't like to name companies, so I'm not going to do that, but through other brokers that they work with and so forth. I've been using these for about 5 years. What really got my attention is how can we provide clients great performance in flat or down markets? And so these are examples. So these notes, clients have downside risk if the indexes go down 30% over the note period. They're generally 1-year notes, sometimes a little bit less, 9 months, sometimes 15. But it's so powerful, right? If the index is down 15, 20% and you make 7%, right? So really caught my attention. We have these types of notes each month. We go out in the marketplace. Sometimes we have notes specifically for our investment clients. Brookstone Capital Management is our registered investment advisor firm I work with. We're independent. There's about a couple hundred people like myself around the country. And so our couple hundred clients, or the couple hundred advisors' clients, have access specifically to a note like this each month just for our clients. And then there are other notes that institutions like Bank of America, Chase, Citigroup have, and we go out and handpick ones that we think make sense. I don't have to use any of them. We only use ones that we think make sense for the client in their specific situation. But you can see a 10% interest rate, right? A 10% annual interest rate, that's just crazy compared to what CDs, compared to what 10-year treasury rate is, right? And so does this mean that everyone should have all their money in these things? Absolutely not, right? Because, but most people are okay taking risk. We want to get paid for the risk that we're taking. We want to be intelligent about it, right? So these are, again, these are investments. These aren't guaranteed by a bank. It's a debt. So the company you invest in that note, B of A, is going to be paying you interest, right? Chase is going to be paying you interest. So just as any loan, you want to be comfortable with the financial strength of the issuing bank, right? Because they have a debt to you. On our website, of course, you can reach out to me if you have questions about this, but if you want to learn more on your own, right, on our website here, you can we have a 3-page PDF. Click on Access Now, or click on Learn More About Structured Notes. And you can pull up that 3-page PDF and go through it. We also have a little bit more about our approach, value of an advisor, this video here. So you can check that out if you haven't. So this is a big philosophy. I don't care what it's called. I care what it does. So I just tell you about structured notes and index annuities, and I love them, but I don't love them because of what they're called. I love them for what they do for my clients, the certainty that they can provide, the above average interest that they can provide. So I also don't hate stocks, right? We use them quite a bit. I just, bonds just don't make any sense, traditional bonds. And so if someone is doing that, right now they don't, in my opinion. So if someone is recommending that, I would suggest that it's probably in their interest more than it is in your interest or their company's interest, right? And so one of the challenges, again, is you have some, there are some people that, they say, hey, I'm a handyman, but they only have a hammer, right? They don't have all the tools. Now, just again, I don't want to be overly critical on the investment side, right? Because there's also people that are only over here and that are telling you, oh, you got to get your money out. The market's terrible. And no, it's just, how do you find the right fit, right? So the key for most people is work with an individual, work with companies that have access to all the tools, understand the tools, will take the time to understand you, and then can recommend the right tools for you and your family. And that's the approach I take. And now I'm going to walk you through 3 examples of situations that client families that I've worked with over the years, and we've changed the names, changed the details a little bit for privacy. And so primarily the type of people we work with are people that are in retirement or approaching retirement. We do have a handful of younger clients. I'm happy to try to help people that are serious and committed to making financial improvements in their lives. But we make the most impact, and this is where we have our greatest focus. So here's an example. We call them Tom and Tina, 64 and 62. He recently retired. She wasn't working. Primary concerns were having enough income in retirement. They're concerned with the fluctuations of the market. They wanted to address long-term care. They were wondering around Social Security, what should they do? And they were a moderate risk tolerance. So here's what their situation looked like when I met them. They came to one of our seminars and heard a talk like this and requested a consultation. We sat down, right? And so the bulk of their retirement savings was still in his 401k. He had recently left his company, but he wasn't sure what to do with it. And 401ks are great, especially if your company is giving you a big match. What's not so great is you're limited to the options that the plan has. And in most cases, they're stocks and bond funds, right? And so he had it all in bond funds, right? Because he didn't want the volatility of the equities, right? But he didn't have some access to some of those other options that I showed you. Tina had an IRA and also in bond funds. So they were really, again, wondering around what should they do with Social Security, how much, they could either start drawing from their IRAs and defer Social Security. They could start Social Security early, do a combination approach. They also didn't want to have an annual payment for long-term care. They didn't want to be paying $300, $400, $500 a month for the rest of their life, but they were really concerned about long-term care. They had some family experience around that with their parents, and being tax efficient is an area that I love helping clients in, because again, that's something we can control if we understand the rules and we apply it properly, right? We do the best we can with the market and indexes, and interest rates, but we don't know we have no control over that, right? So they also had more money than they needed in the bank, and it's not because that was a great choice for them. It's just like they just didn't know what else they could do with it, and they didn't want to make a decision that didn't work out, right? And that caused sustained losses, right? So what we did is, they were moderate risk, so we incorporated the fixed index annuities for in the soon bucket to give them a bridge for the next 6 years. So they needed about $40,000 a year to draw down until Tom is 70. So we decided that, so Tom had a pension from his company. So he was getting that now. And Tina we decided to start her Social Security at 62 and defer Tom. So his Social Security benefit continued to grow. The benefit of that, not only is the growth of his larger Social Security benefit, but it also provided some great planning from the perspective of surviving spouse. For a surviving spouse, they get their Social Security or their spouse's, whichever is greater. And so generally it makes sense to, in that situation, to at least have one Social Security benefit larger defer. Also, Social Security, they're guaranteeing an 8% increase each year you defer. We don't have those types of guarantees right now, or at all. Right? Sometimes we have guarantees similar on certain insurance products, but nothing like that right now because of how low interest rates are. So the Social Security, deferring Social Security right now is in many cases more attractive than it's ever been. Also, Social Security benefits are taxed at a lower rate than other taxable income. So if you have IRA income or pension income, fantastic, but you're going to be paying more in taxes on that generally than you will on Social Security. So we built a bridge so they could confidently spend down some of their savings, and it's principally protected. So if the market goes into the dump over the next 2, 3, 5, 6 years, their income, their $40,000 a year of income, they don't have to stress and worry about it. After that 6 years, they're set because Tom's Social Security is going to kick in. So what do we do with the rest? Well, so we're going to invest the rest for growth. They were also able to utilize a very unique strategy that provides long-term care protection for both of them, and to do it in a very tax efficient way. So he was able to go directly from IRA directly into that. So he didn't have to pay a bunch of taxes getting it out of the IRA. And then we took some of the excess bank dollars and opened an after-tax specific type of insurance policy that had value in these 3 areas: tax-deferred cash growth, so chronic and critical illness benefits if they need it in that situation, and then a death benefit. And so that, in addition to the fixed index annuities and the structured notes, this would be the third area or third asset class that I consistently add a ton of value for folks in, because they're not familiar with it. They don't have it. They didn't know about it, right? And so these are after tax. So a lot of times the recommendations are based on where's the money. We talk about asset location. Is it an IRA? Is it a Roth IRA? Is it an after-tax account? Is it in the bank? Is it in, all those things matter into what's the best solution. But for so many retirees, they want to be conservative with their money, but they still want it to grow if they need it, but they want care if they need it. And if they never need the cash or the care, oftentimes they like the idea of maximizing it for their beneficiaries, or even if it's not for the kids or grandkids, it could just be for their surviving spouse. So here's what their plan looked like after. In addition, over the next 6 years, we're going to be converting the growth IRA into a Roth IRA. So we're going to be paying some taxes each of the next 6 years at relatively low rates, and before Tom draws his Social Security. So when Tom's Social Security starts, they're in a fantastic situation from a tax perspective, right? Where they're paying very little, if any, taxes, as well as they're in control of that, right? If they want to take cash out of these products, if they have tax deferral, and that's a key concept for many retirees after RMDs, is a lot of times they lose tax deferral options and opportunities. So I got to keep moving. I'm doing okay on time. So, so what did we do here? We took money that was in bond funds, not because they wanted them in bond funds, because that's what they knew and they didn't know where else to go. And we were able to find better options. And a lot of times we blend it, right? So if instead of someone having 100% in bond funds, right, because they're just scared of the market, say, well, what if we had 70% of your money with 100% principal protection? If that was the case, would you be comfortable accepting market volatility with 30%? right? The ups and downs with the 30%. And most of our clients say, yes, that makes sense, right? Because I don't care which one does better, right? We care about the result that we're able to create. Now, people really struggle with that, right? Because a lot of times they're like, well, how did this one do? And, oh, well, this one did better last year, so I should have more in that. And we understand why people do that, but again, we can't make our decisions looking back. We got to make it looking forward, right? We're able to get the bank dollars working for them and their family in a much, much more better way. We incorporated planning around the Social Security. We incorporated tax planning. We're able to protect long-term care without them having to have a monthly payment for the rest of their life. And if they never needed the care, then there'd be a benefit to their family, right? So do we have, if you have a question about that, type it in the chat box. Key observation. So I was able to do a lot of, I mean, this is a great opportunity. It's like the perfect situation. You're able to just make improvements in so many areas. Now, a lot of people, after they meet me and get to know me and spend time together, a lot of times they said things like, I wish I met you 10 years ago, or I wish I knew you 20 years ago, right? In this situation, we were able to do a lot of good, but we could have done even better, right? If Tina or Tom had come to me at 59 and a half, right? We met at that point, right? So when you're separated from service or 59 and a half, you have, according to your plan, but on most plans, they allow what's called in-service rollovers. So again, when the money's in the 401k, we're restricted to the options, but once it's outside of that in an IRA, then we could use the fixed index annuities for a portion. We could use the structured notes for a portion, right? Now, if you're self-employed, you don't have to wait till you're 59 and a half, right? Because if you have an IRA, you could be utilizing some of those other strategies besides just stocks and bonds at any age, right? But a lot of people have a substantial amount of their money in employer plans. A lot of people think like they have to wait till they retire. In a lot of cases, they don't. Other thing that sometimes people come up with is, well, I don't want to make any changes because I'm going to have to pay a lot in taxes. And yes, if you were to take a withdrawal from your IRA, it's taxable, but you can do what's called a custodian to a custodian rollover. And with our clients, we help them facilitate that and handle that to avoid any mess ups. Because if you do it on your own, there are a couple situations that could cause tax problems. You don't have a taxable event when you do that. So I'll take a minute break. Any chat questions around Tom and Tina? Okay, we'll keep moving. This is our second case. So also on, if you go to our website under our Who We Serve tab, this information is on there. So we have these two, and then also the third group that we're able to make big improvements with is substantial savers during their working years. So with our eliminating income tax and retirement strategies. But today we're focused on these two. So successfully retired. I think a lot of people that are successfully retired, they're like, why do I need retirement planning? We're retired. We already made it to the top of the mountain, right? We're good. And hopefully that's the case. I would say for most people in this situation, yeah, you're good, but is good enough? Like, why settle for good if great or amazing or better is available? And a lot of times it just comes down to they have to adapt and they have to make changes because the strategies and the options that were attractive then, right? There are people, you used to be able to get 4, 5, 6% on a CD, right? You used to be able to get 6, 7, 8% on a bond portfolio, right? Great, fantastic approach in that environment. Not so much today, right? Great, you've made it to retirement. Now it's not about accumulation for you, but right, protection, distribution, but it may also be about maximizing assets for your kids, your grandkids, your charity, your surviving spouse, other concerns, right? And so that means that strategies, financial tools that didn't make sense for you before start to make more sense for you now. But like a lot of things in life, when it's something that it's new, it's something that we're not familiar with, a lot of times we're not comfortable with it, right? We maybe resist it, right? Until, and you know, varies person to person, but some people never get past those things, and that's their choice. But for a lot of people, it's just a matter about understanding and education, and you know, things like we're doing today, right? So case number 2, Larry and Lisa already retired. They didn't like the market. They're a little bit concerned with long-term care, so they still wanted better growth, but they weren't willing to sacrifice safety just to get growth. So they were on a risk tolerance. They were not moderate, right? So moderate conservative. So you'll see the recommendations here were different than for a moderate risk. So this is what their situation looked like when I met them. And so again, they wanted safety and growth. They had some more money than they needed in the bank. They knew that wasn't doing the best, but again, they didn't know what to do with it, where to put it. So in those situations, people leave it there. And so, you know, so these are the assets, kind of how it looked now. They had a very small traditional long-term care policies, which in that case, it often makes sense to keep, but oftentimes it's not enough protection. And, you know, I also have presentations and recordings around long-term care, and we have many different strategies to address that. And traditional long-term care standalone policies is one of 6 different ways we help clients do that. It's generally the least attractive when it comes to robustness and value, but if it comes down to cost, that's generally the approach. So you can see again a lot of bond funds, a CD, and a fixed annuity. So what we're able to help them do is to take the CD. We left the fixed annuity alone, right? Because it was getting a good rate, and you know, these products are longer term in nature. So sometimes we meet people and there is something better than their current annuity right now, but it doesn't make sense to change right now. We have to wait a few years until the penalties drop down to where a change makes sense. So that was left in place. So on his bond funds, right, we decided to take some risk with the structured notes, his later bucket, and the CD we got working in a fixed index annuity, so principal protection, right? They weren't happy. They didn't have their money in the CD because they wanted to make, you know, 1.5%. They had it there because they didn't want to lose. So provided the same no loss with better upside. We're able to, with Lisa, she took about 2/3 of the bond fund IRA and split it, right? So that same concept that I just talked about. Would it make sense if, like, and so in this case, you know, 70% of the IRA wanted safe, okay, taking market risk. We also use some dividend stock, a managed dividend stock strategy that we have, and then we mix it in with structured notes, and we use that in her IRA and Roth IRA. We took 80,000 of the bank dollars, and we got that hybrid index life policy, single pay. They don't have to have a payment ongoing. We keep the death benefit low so that the growth on the interest of the cash value overcomes the policy cost, and they're enhancing their value if they need it in care. So it's tax deferred cash value, tax free in a care, tax free in a death benefit situation. So recapping here, again, CDs and bonds to FIAs, bank dollars, right? We're also able to add some value here from a surviving spouse perspective, right? So if she doesn't need the care, right, there's more money, you know, for him. And if she needs the dollars, she has the cash value there. We decided to leave alone the care sometimes. And so in this situation, there was dollars available to do additional care planning. But again, this is another situation that comes up, is some of these options you have to health qualify for. So in this situation, there were some health concerns that made it to where some additional options weren't available or cost prohibitive. And so people ask me, when's the best time to do that? Well, you know, the healthier you are, the younger you are, and it's when you can afford it, you know, when you have the assets, right? So it's all a matter of opportunity cost. What is your money doing for you? What do you want it to do for you? and then comparing side by side. And we have a simplified one-page sheet, which I'll show you as we wrap up. So we're doing pretty good. About 15 minutes to go, I think. So client case number 3. Any questions on that? No. All right. If you have it at the end, we'll do that as well. Okay. So here we had Amy, widowed, could be divorced, and so common example, either widowed or divorced. Most people that I talk to, at this age, have some level of uncomfort with the volatility of the market, right? There's a few that don't, but the majority have some level of concern around that, right? And then most are also concerned around long-term care, right? They see it around them, they've experienced it in their own family. And so the main difference here, aside from married, versus single, was, Amy has children and grandchildren, and yes, she wants to maximize these assets for her use, but if she doesn't need them, then she wanted to maximize them for her kids and grandkids, right? So because we're a little bit behind on time, I spilled the beans on you, right? I kind of jumped ahead there. So here's a situation with Amy. Quite often, I mean, a lot of older folks that have a lot of excess dollars in the bank. That worked fine years ago when you can get, 4, 5, 6% from the bank, but not anymore, right? So she had after-tax mutual funds and then an IRA, right? And that was kind of split in that 60-40. So she's willing to take a little bit more risk here. So what did we do? Well, again, so we took 150,000 of the excess bank dollars, and we took the after-tax bond, so that's creating taxable income that she didn't need, and we combined that and we put it in the single premium policy, where tax-deferred safe growth for her, minimum guarantees, chronic critical illness, and if she doesn't need that, utilize either one of those, then her kids and grandkids get a lot more money, income tax free. I'm sure anyone will thank you for leaving them anything, even an IRA where it's all taxable income. But if you're trying to do the best possible for your family, if you're trying to maximize, right? Like I try to do for my clients, my family, right? Especially if your kids are still working, it's much better to leave them a tax-free death benefit, insurance benefit, than it is a taxable IRA, because a lot of times the working kid, their adult children are in a much higher tax bracket than they are. And so now, if you're in that situation and you can't use the life insurance, you don't want to use it, right? The other way is to start doing the IRA to Roth conversion, right? So, and then on the IRA dollars, right? What we did is, right, instead of that traditional 60-40 portfolio, where the 40% is like doing what for us, we split it up, and we, 50% principally protected, 50% in structured notes. Now, because we just used the structured notes because she was moderately conservative. So if she would have been moderate, then we could start using other equity strategies, such as the dividend stock strategy. We also have a volatility strategy that I like to use. Also have, we could just go into 100% equity model to just try to have some money that does what the S&P does, right? So again, it comes down to the client but that's why in this situation, she didn't have, the recommendation was not, right? Because this was soon bucket for moderate conservative. Now, if you think back to Lisa, she was also moderately conservative, but we took the equity risk in her later bucket, right? That's where we added the dividend stock and some of the equity strategies, right? So those are some key differences, key highlights. So as we're wrapping up here, so if you have some questions, go ahead and tee them up, in the chat. I'll stop the recording in a little bit, and if you want to pop on and ask me, we can do that as well. So why, I think this is a big question. So why would successfully retirees need to make changes? hopefully you're better educated and you have a higher degree of awareness over why that's the case in today's environment, right? Low interest rates, high volatility, things that worked great before may not work great again, maybe some newer options, right? And enhancements, right? Technology improvements, right? Maybe their goals changed, right? Generally, quite often, I view our financial money as it's just a resource. It's a financial resource. It's a very valuable resource, right? It enables us, shelter and food and travel and fun and all that. But none of us have figured out how to live forever. So, the average lifespan is increasing, but most people are aware, 80, 85, 90, that type of thing. So what I tend to find and experience with a lot of folks is as they get older, they tend to look at their money a little bit differently. And it's not as much about, I need it for me, I need it for me, I need it for me, right? They figured out, hey, I have my income squared away. I have these other assets. So a lot of times we separate the decisions. We say, well, this money's for you, but this money is for your kids, your grandkids, your nieces, nephews, sisters, charity, what's the best use of that for them? What is their tax situation? What is, and all that. So this is that comparison tool that I mentioned to you. Again, there's a lot to consider. I try to help people simplify after I have a thorough understanding of their situation, as well as their financial picture, as well as their goals, right? And then we can show them, hey, let's compare investment options versus a protection option, right? What's the best case on the growth? What's the downside? What's the tax impact? What happens if you pass away? What happens if you need care? What happens if you need the money? And a lot of times there's no perfect product that after tax, cash value, care, death benefit policy, in my experience, is the closest thing to perfect that's in the marketplace. But it's not perfect. Oftentimes to create the perfect plan, we need to blend and utilize 2, 3, 4 different financial tools to create the optimal financial plan that provides the right mix of upside, downside, tax efficiency, enhancement of the estate for surviving spouse, kids, grandkids, care protection, plenty of liquidity. So I think, and you can give me feedback, right? We're always open to feedback. We always try to get better, try to learn. How well you think these strategies and this type of approach and this type of planning does at accomplishing those objectives, right? So as we're wrapping up, if you want to reach out and have a conversation, here's my contact information. We will be sending out a wrap-up email with a feedback form as well as a link. So we always offer a complimentary consultation to people that attend and tune in here. And so we are, in today's environment, we're trying to make these webinars as close to what it would be like if you were to come to the library or you were coming to the senior center, where and more we're able to do that is have one-on-one meetings over the phone and do a meeting like this, but it's a private meeting and share screens and complete things digitally. So there you have that. So here's our response sheet. And Kathleen, can you go ahead and type in the links, the response form link and also the Calendly link. So these are the common questions that we ask folks and to give us feedback on and let us know what their concerns are and if they want to have conversations about these and to see if we can help in these areas. Again, there's no cost or no obligation. There's nothing, we don't move money or open things the first time, right? And a lot of what I do is just working with existing clients to make these adjustments as, right, the opportunities have shifted, right? And so if you're new or you're watching this on a recording, recommend the 15-minute phone conversation, answer a few questions, give you some clarity, get to know you a little bit, try to figure out, we can, determine if it's comfortable and it makes sense to have a more detailed conversation. We also, if you're a client and you've heard something new, you want to have a conversation, we always invite that and welcome that. So just reach out to us. This is our, another one of the tools I use, especially when I'm talking to someone initially, is trying to get an understanding of what are you concerned about? What would you like to have improvements on? What do you want your money to do for you? And my goal, as much as possible, is to help eliminate the number ones, right? And so, again, coming back to, if you think about my puzzle and you think about getting value in multiple ways, right? There are strategies that can add value in, right? So you don't have to worry about losing money in the market, right? So you have less of a worry about the nursing home, right? Tax deferral, income replacement, right? So a lot of times there's things that you can choose that are going to help in more than one area. Whereas an older way of doing things was you had your investments, you had your long-term care policy, then you had your a life policy. In today's enhanced age, you don't have to do it that way anymore if you don't want to. So if you're not already getting our email communications and you'd like to, we highly recommend it. We have two different general lists. One is a weekly economic update, and the other is, we call it our financial stay informed, is more like a monthly email or two, as well as whenever we have events like this, whether you're on either list, you'll get that information, be able to attend, tune in, share that information with others. I live in Las Vegas, our office is in Summerlin, but more and more we're virtual. So if you're out of the area, or you're across town and you don't want to come to the office here, right? We have, if you're in Henderson, and you want to meet in person, we work together, we can make accommodations and all that. But more and more we can do a lot of what we need to do remotely. So thank you for your time. I hope you got a lot of value. And our next webinar is going to be Thursday, November 12th, year-end planning and post-election investment considerations. So I will share with you, whatever opinions, thoughts, takeaways. I can't tell you today what this exactly look like, right? I got to wait till that week and see what's going on. But there's definitely some year-end planning, right? Important thing is, are there going to be tax changes? What are those tax changes going to look like? Because those are things that we can control. Okay. So thank you so much for tuning in. I'm going to go ahead and stop the recording, but I will stay here on and we can